Meta stock just took a sharp hit, dropping around 8% in a single day. Zoom out, and it's down roughly 10% over the past month, and more than 17% so far this year. But here's the strange part. Analysts still think the stock could rise nearly 60% from here. So, what's going on? Why is the stock falling while the upside still looks massive? Let's break it down. The biggest catalyst behind this drop isn't earnings, it's legal risk. A jury recently ruled that Meta, along with YouTube, is partly responsible in a case involving social media addiction among minors. The key points: Instagram's design was found to encourage addictive behavior. Meta failed to properly warn users. Meta was assigned 70% of the blame. The total damages? About $6 million. Now, $6 million is nothing for a company generating over $200 billion in revenue, so why did the market react so strongly? Because this isn't about the money, it's about precedent. If this ruling opens the door for thousands of similar lawsuits, the long-term financial impact becomes unpredictable. And uncertainty is something markets absolutely hate. When investors value a company, they're really trying to estimate one thing: future cash flows. If those future earnings are stable and predictable, investors are willing to pay a higher price. But when something disrupts that predictability, like potential legal liabilities, valuations start to shrink. That's exactly what we're seeing here. Not necessarily a collapse in fundamentals, but a drop in confidence. And that leads to lower stock prices. Now, the legal issue isn't the only concern. There's a second, much bigger question looming over Meta. What are they doing with all their money? Meta is aggressively ramping up capital expenditures, or capex. To put this into perspective, years ago, Meta spent around 10 to 15% of revenue on capex. Now it's approaching 35 to 40% of revenue. And projections suggest it could reach nearly 50% of revenue. That's huge. It means nearly half of everything the company earns is being reinvested. And investors are asking, will this money actually generate returns? This concern isn't coming out of nowhere. Remember the metaverse? Over the past few years, Meta spent roughly $80 billion building it. And so far, the return has been basically zero. That's a massive capital allocation miss. When investors see Meta doubling down on heavy spending again, even if it's in AI this time, they're understandably cautious. Despite all of this, there's still a strong bullish argument. Here's why. Strong earnings growth. Analysts expect around 15 to 17% annual EPS growth. Reasonable valuation. Forward PE is under 20. That's actually cheaper than the broader market. High profitability. Meta still generates excellent returns on invested capital. Cash flow machine. Tens of billions of dollars in free cash flow annually. Even if growth slows slightly and the valuation stays the same, the stock could still deliver solid returns over time. That's why analysts remain optimistic. So, is this a buying opportunity? Here's the honest answer. It depends on how you view the risks. Bullish view. The sell-off is an overreaction. Legal risks won't materially impact long-term earnings. AI investments will pay off. Bearish view. Lawsuits could escalate significantly. Capital spending may not deliver strong returns. Valuation could compress further. Personally, this situation comes down to one key question. Can Meta turn its massive investments into real, profitable growth? If yes, today's prices could look like a bargain. If not, there could still be downside ahead.
So what do you think? Is Meta a discounted opportunity or value trap with rising risks? Drop your thoughts in the comments below. And if you found this helpful, don't forget to like and subscribe for more deep dive stock analysis.